Paul, you know me. I love Apple. Our viewers love Apple. Warren Buffett is talking about Apple. What did he say?
So Warren Buffett has been buying Apple since I think 120 or so per share, maybe a little bit lower. He recently had his big event in Omaha, and they asked him about Apple. His comment was, I wish I'd bought more Apple, but I didn't think it was going to rebound that quickly. If it had kept going down last quarter, who knows how much I would have bought. The guy loves Apple. He loves the return on invested capital. He loves the buying back of what he considers to be cheap shares. I'm sure he loves the moat. That moat in Apple is incredible. What's a moat? A moat is the protection around a business. Warren Buffett always looks for a moat when he invests in large companies. He wants to see, do they have protection for their margins? Because guys, if a company doesn't have moat, their profit margin will revert to the mean at some point. Because if they're high profit, but it's easy to enter, like AWS, AWS is Amazon Web Services. And I always said, I'm like, well, all these other companies are going to enter. And sure enough, every company's entering because it's high margin and easy to enter for all of them. So the margins are going to get decreased. Same thing. With Apple, though, imagine building another Apple today. I literally think if you gave somebody $1 trillion, they could not replicate Apple.
Yeah, the brand is just so strong and people are so passionate about it.
Yep, absolutely. They're involved in everything, a part of our life. I have Apple Music. You have Apple Music. Seth always says he has 17 iPads at home. I have a PC upstairs and here, but I still have an iPhone, refuse to have an Android. So there's all these benefits to Apple that Warren Buffett loves. So the question we have to ask ourselves is,
are we buying Apple?
Are we buying Apple? And if we're not buying Apple, what price do we want to pay for Apple? And we will get to that at the end of this video. But in the meantime, let's look at the fundamentals of Apple using our 8-pillar process. So we go to our software, we type in Apple, which is Apple.
I don't like that.
Yeah, what is the deal? By the way, I always wonder now when I'm spelling Apple the full word, am I misspelling it? So I wouldn't even get into how dumb I am when I say that. I
don't like that ticker symbol. Change it, Apple, damn it. All right, go on, Paul.
So their 52-week high was 183, and their low has been 122, which was about a year ago. So guys, it's a $2.6 trillion company. Trillion. Keep in mind, when Cisco was said to be the first $1 trillion company 22 years ago, when somebody said it was going to happen, Apple was on the verge of bankruptcy basically back then. And now it's $2.6 trillion. Go figure that one out. Pillar number 1, we want the 5-year PE ratio to be under 22.5. It is 37.5. That is an X. Pillar number 2, we want the return on invested capital greater than 9%.
This has got to be good.
Oh my gosh, 33.4%, Seth.
Most of that is from me, myself, and Mo purchasing all the products.
Correct. Mo literally buys 8 iPhones at a time and then sells 7 of them.
In fairness, I do have 3 phones, 3 iPads, and 3 Macs, and a laptop now, I think.
So that's 10.
Oh boy. Okay, go on.
Okay. Guys, keep in mind here, they pay a dividend about 0.6%, which eats up $14.7 billion out of their free cash flow. But the good news is last year's free cash flow was $106 billion. The last 5 years, they've averaged 75. So it's less than 20% of their average in the last 5 years. It's adorable.
Isn't that funny?
Pillar number 3, we want to see revenue growth over the last 5 years.
I assume it's up, Paul. Come on.
I assume so as well. Let's go to the income statement on our software. 5 years ago, it was 229. Last year was 365. Check mark there. Pillar number 4, we want the net income growth to be positive over the last 5 years. So we scroll down a little bit on the income statement. We see our net income line. 5 years ago, 48.35. Last year, $95 billion. Almost double. Almost double in the last 5 years. That is incredible. Pillar number 5, we want the shares outstanding decreasing because we don't want the company diluting us as owners, right? We want to be getting a bigger and bigger piece of the pie, a bigger and bigger piece of the revenue and profit. So they're buying back shares. That's what we're getting. They had $21.88 billion at the start of 5 years ago, and now they have $16.7 billion. Wow. They've bought back basically 25% of their shares. Pillar number 6, do they have reasonable long-term liabilities? So what do? We go back to our main page and we scroll down to the 5-year average free cash flow that we looked at before. We multiply that by 5. What does that equal? $375 billion. We want their long-term liabilities to be under $375 billion. So we go to the balance sheet and we go to our most recent quarter, scroll all the way down. Guys, it's $155 billion, less than half that. They can pay off they did $100 billion last year in free cash flow. Based on replicating that for the next 5 years, in a year and a half, they could pay off all their long-term liabilities. That's incredible, isn't it, Seth? I mean, this company is shooting on all cylinders here. So far, we have all checks except for the 5-year PE. Now, pillars 7 and 8 had to do with free cash flow. What is free cash flow? It's cash from operations less your capital expenditures. I'm going to quiz Seth. It's been a while since I've done that. Seth, what are the 5 things you can do with free cash flow?
This is my specialty, Paul. They can buy back shares.
Yep.
They can make acquisitions or buy companies.
Yep.
They can pay a cute dividend, which they do. They can pay down debt, which they have very little of. Or they can reinvest themselves and make more stores and malls, which I love going to.
Seth, you got it 100% spot on. For the record, the last one we did, I hadn't asked him in a while, and we both forgot because I was so off guard. The point is, those are the 5 things you can do. You can do 1, all 5, any combination, none. But these are the things you can do with free cash flow. It's the true lifeblood of the business. So I added this line. We added this line to the software to make the math easy for you. Free cash flow, $51.8 billion to $92.95. Check mark there. Our final metric.
Come on.
We want to come up with a market cap to just get an idea of where we should be. We want to do a 20 multiple of the last 5 years of free cash flow. So the average was 68.2 multiplied by 20 equals $1.36 trillion.
Oh, Paul.
Versus the actual market cap of $2.6 trillion.
Market crap. You ain't kidding.
Yeah. That's a big X, guy. So I did a lot of math here. Luckily for you, our software does all the math for you. So we go to the 8 pillars tab. And guys, this is one of those companies where we love these companies. You know why? I want to own this company. But I might necessarily want to pay the price today. With that said, we're going to use a stock analyzer tool in just a minute to figure out exactly what we want to pay for the business based on our assumptions. But as of right now, I know for a fact I want to own Apple. But I want to make sure I buy it at the price that makes sense, that can maximize my returns. The same thing happens with you. We just hear a great company, we want to buy it. I urge you to exhibit caution. I used to do the exact same thing. I love this company, let me own the stock. No, you want to fall in love with the numbers and buy the company because of that. So every investment is the present value of all future cash flow. You are buying a piece of a business. So we created the stock analyzer tool. What this does is, since we don't know the future, it allows you to make assumptions about the future based on revenue and profit growth over the next 1, 5, 10 years, or 20 years, whatever you want between 1 and 20, and determine the exact price you need to pay based on those assumptions today. It does all the math for you and says, here are your assumptions. Here's what you need to pay to get the return you want. So let's start with revenue growth. Sethi.
Boy. So I know
Please help me out here.
I know you. So we got to be conservative. We want to get Apple as a good deal. Not
on the low end, we want to be really conservative. In the middle, we want to say, this is probably what they'll do. The high end, hey, let's say they kill it. Now keep in mind, Apple already did $360 billion in revenue. How much faster can they grow?
So are we talking 7, 9, 11?
Oh, I don't even think that high.
Oh, Lord.
See, to me, I go 4, 7, and 10. Because I look at it saying, guys, they're so large. For them, they've already, their revenue is already up how much in the last 10 years? For them to go another, 10% is going to make them a $1 trillion revenue business. That's highly unlikely.
My only argument is we keep buying the products. The phones last about 2 years. My kids sit on an iPad, so I'm
I agree with you.
churning through the products.
But it's saturated right now. Like how many new people can possibly buy Apple products? Everybody already owns them. And the Android users aren't doing it. They make fun of us for having bad battery life. So for us, the only growth I see is international with emerging economies. That's about a 4% growth number. Okay. 7, if they're able to come up with some new services and get some revenue, and 10 on the absolute high side.
Remember, this tool is built for you at home. So if you want to change these numbers and go frothy,
absolutely change them. Absolutely. Profit margin. Now, profit margin is probably going to stay a little more consistent. So I'm going to do 21.5, 22.5, and 23.5. Free cash flow margin, I'm going to do 24.5. I'm going to do 24, 25, and 26. PE. Now, this is a brand, and this is a moat. I'm fine doing 15, 17, and 19. Same with price of free cash flow. And guys, if you watch past videos, I've given lower multiples, but I think with Apple and its moat, it deserves a higher multiple. There are 2 reasons to pay a higher PE or price of free cash flow. Great moat or major growth potential. I don't think the major growth potential is there for Apple, but I could be wrong because 10 years ago, I probably would have said the same thing. 5 years ago, I most certainly would have said the same thing. So, final metric, I put in my desired annual return. I put 12.5% in. Why? Because I want a margin of safety, and I can invest in an ETF and get 9 or 10%. So if I'm going to do the extra work, let me get a little bit more return for it. I hit the analyze button, and based on my assumptions and numbers, this is what I'm allowed to pay for Apple. Low end, 70 to 75 bucks. High end, 130 to 140. Middle level, 95 to 105.
Paul,
okay.
I can't remember all those numbers.
Right. So what you should do here is, now I sit there and say, you know what? I don't think I'm going to buy it at 130, but I'll set that price target for there. So that way I can start paying attention to it. I hit add to my watch list. When it goes below 132.9, I hit notify me. And now the software, I'll get an email, I'll get a notification there, and I'll get a notification on my phone through our software to buy the stock at 133.